you mentioned, the Hong Kong market, IPO market is on fire, surging sevenfold year over year. I think that's actually placing Hong Kong as number one globally, with over 100 billion Hong Kong dollar being raised in the first half. We think there are three key drivers behind this key dynamic. First and foremost is ample liquidity. As we can see, the 1 month HIBOR is below 1%. And in the meantime, southbound inflow is amounted over 700 billion, more than doubled than last year. And even if you look at trading liquidity, right, we're talking about 240, 250 billion a day. That's also doubled than last year. So that's the first key driver. And secondly, Hong Kong market is technically in a bull market. And in a bull market, you have more IPO activities. Last but not least, I think that's also owing to the fact that Asia IPO has been slowing down dramatically, since the beginning of last year. But in the meantime, Chinese companies, they do have needs for innovation, for going global. And then that's why Hong Kong becomes a natural place for them to raise capitals.
I want you to weigh in on a recent policy announcement which came out just earlier this week, where China is trying to boost consumption, and in doing that, they're supporting new listings. Why is this one of their policy moves?
Yes, to support consumption growth, obviously, the wealth effect is very important. And stock market is where you can create wealth effect, both from the existing listed company, but also, the new listing. And then that's why I think there's a fine-tuning in terms of IPO pace in the Asia market, particularly last week at the Lujiazui Forum, right? The fifth set of listing criteria for stock market, for Chinex board, have all resumed. We're also seeing IPO filing picking up space in the Asia market as well.
As we talk about the A-share market, now China has invited some of these Hong Kong listed companies to be listing over on the mainland. You've at HSBC Qianhai have come up with a long list of eligible names. And of course, we all know that Tencent, Alibaba, Meituan, these are big brand names in China, but have yet to have A-share listings. Why would this be a good time for them to do so? And why haven't they done so already?
That's a very good question. To be honest, for the H-shares has always have an EGM channel to go back and get listed in the A-share market. And for red chips, the regulation actually started in 2018 to allow red chips company either do dual listing or issue CDR, in the A-share market. So in the year of 2020 to the year of 2022, we have seen 7 major red chips get listed, in the Shanghai Stock Exchange. But none of them has done so, in the Shenzhen Stock Exchange yet. And remind you that, this year, in about 2 months' time, is going to be the 45th anniversary for the Shenzhen Special Economic Zone. So that's why the opinions to deepen and accelerate Shenzhen's reform, that piece of policy document was actually effectuated a year ago, but only made public about a week ago at a State Council and NDRC news conference.
I remember back in 2006 when there was the listing of Bank of China. First it listed in Hong Kong, and then it listed on the mainland 1 month later. It was ICBC that was the first mainland company to have a dual listing on the same day, Hong Kong and in Shanghai. That was, of course, a very big deal. And that was really the trend then, when the companies from China would come to Hong Kong, list, and have an A-share listing at the same time. How come we haven't seen anything like that since, 20 years ago?
Exactly. I remember that deal was done in 2006. So I think, for anyone who has worked in this market for over 2 decades, including both of us, know that kind of details really well. I think at the end of the day, IPO is actually a bottom-up decision adopted by the company, right? And I think there's still a huge, valuation gap. Despite the fact that A versus H share premium has been coming down in the past few months, we're still talking about 20-30% premium in the A share market. So that's why if you are doing the H-share listing, and if you want to get listed in the H-share market, usually there's a big premium. Usually that means that you have to be very careful with the supply and demand situation. So the listing in the H-share market, even for the dual listed one, tends to be much smaller in terms of the percentage of float. And then that's why I think a simple conclusion is that Hong Kong is still a better place to be if you want to do, particularly considering companies now trying to go in global, they want to raise Hong Kong dollar or hard currency in order to facilitate their IPO process.
There are a couple of companies and just a handful where the H share is traded at a premium to the A share, and Contemporary Amprex becomes the latest to be in this small category. I think BYD, China Merchants are the other few. Why is this so?
Yeah, there's only a few names, as you pointed out. It's probably 3 out of 200, and that's BYD, that's China Merchant Bank. And historically, I think, Anhui Conch, if you could remember that cement name, at a very brief period of time, the H-share is also trading at a premium to A. But in general, H-share is still more expensive than H-share. So for those names, I think, you tend to find out they have a very high institutional investor holding. They got a lot of, anchor investors. And particularly for CATL, they didn't exercise the green shoe options, so which means what's floating in the market is quite limited. And considering also liquidity situation in Hong Kong is highly ample, as we talked about, the 1 month HIBOR is actually below 1%, owing to the fact that Hong Kong M&A has conducted numerous rounds of intervention, given the Hong Kong dollar has weakened to the upper band. So it's liquidity, it's market supply and demand. But I would say it's still a very small set of companies that can trade at premium over A-share.
What would the risk be for these red chips or these Hong Kong listed companies to return to the mainland for a listing? I know that, there is, of course, this trend of the Hong Kong listed shares being more expensive, but then why with the Stock Connect would they need to have a mainland listing?
Definitely there's one technical consideration, right? Because many investors can already access shares, in Hong Kong through Stock Connect. And in the meantime, for companies that decided to go back in the domestic A-share market to get listed, needs to get used to, a new set of, regulations, a new set of, regulators that comes with regulatory cost. So I would say that's probably the, most important consideration for companies when they're making up this bottom-up decision.